Asian stocks gained on Tuesday, tracking Wall Street equities fresh all-time highs. Investors cheered US President Donald Trump's visit to China this week, with expectations for trade truce expansion and extension and Iran on the agenda. For now, it is tough to see much progress on the US-Iran talks before this Trump-Xi summit, given the importance of the US-China bilateral summit this week. Well, Iran peace is put on the back burner as a front and center issue, at least for Trump. The messaging is clear: patience and no agreement, given what Iran came back with in response to the US peace proposal. Oil prices rallied as Trump said the US ceasefire with Iran was on life support. The president dismissed Tehran's response to a US peace proposal as quote-unquote stupid. His remarks stoked worries that the 10-week-old conflict will drag on, paralyzing shipping through the Strait of Hormuz. Brent crude prices rose to above $105 per barrel after testing the $100 mark last week. Inflation expectations are being repriced higher, and the US 10-year Treasury yield is back above 4.4%. In a more worrying sign, the dollar and top commodities gained in tandem. Traditionally, a dollar gain leads to losses in commodity prices. However, in the previous session, gold and silver added more than $1 trillion in combined market value, even as the greenback rose. On Tuesday, risk assets started to reflect a more somber mood. Worries are of Trump's new workmanships amid a war that is already hitting consumers around the world on all fronts. Wall Street futures and Bitcoin edged lower. The S&P 500 rose to a fresh record high on Monday. Well, this comes after the benchmark marked a dubious record. Friday marked the fourth time in history that the benchmark closed at an all-time high, while 5% of its members hit fresh 52-week lows. The last time this happened was way back in December 1999. Before that, it was in January 1973. The first time the benchmark saw this dubious record was in July 1929. Analysts are increasingly concerned about a bubble in Wall Street benchmarks. According to Bull Theory's research, for the first time since the dot-com crash, the 40% bubble concentration rule was triggered on Monday. If history repeats, the entire market could be at risk. Every time the top 10 stocks have made up 40% or more of the total market, a major crash has followed soon after. Well, this pattern holds across nearly 200 years of market history. In 1929, the top 10 stocks hit 44% of the market. The Great Crash followed. In 1965, they hit 40%. The go-go bubble burst followed. In 2000, they hit 41%, and the dot-com crash followed. Today, the top 10 stocks make up 40% of the market once again. Apple, Microsoft, Amazon, Nvidia, and Google alone make up 25%. Well, this level of concentration has only been seen at the peak of the largest bubbles in history. And each time, the entire market has suffered, not just the top stocks.